FHA loans. What does a payment really look like? What's up, guys? How you doing? Hopefully you guys are having a good week. It looks like Thanksgiving's coming up, so family time is coming up. Super excited about that. Can't ever complain whenever you get together with family and have a good meal, and hopefully talk about how grateful you are that we are who we are and we live where we live. With that being said, today I wanted to talk to you guys about FHA loans. Everyone talks about an FHA loan. I've even talked about an FHA loan in the past, but what does an actual mortgage payment look like? Okay, so and then what is insurance and upfront insurance? So I've gone through this in the past, but hopefully this presentation or this talk today will be just a little bit more clear. So what I want to talk about, obviously, FHA stands for Federal Housing Administration. Everyone thinks it's first time home buyer. It's not. It's Federal Housing Administration. Some of the things that we need to be aware of when you're asking for an FHA loan, that this is only for a primary residence. All right, only if you're buying your first home, not your second or an investment. Okay, it's got to be your primary residence. One of the things that makes this attractive is that you are able to put a low down payment, right? 3.5%. So 3.5% of the loan amount. We'll actually go over those numbers here in a little bit. Just know it's a 3.5% down. FHA goes down to as low as 580 credit score. All right. So a lot of times, if you're below 680 or even 700 in some cases, conventional mortgage loans just don't want to do business, right? They'll let you do business, but your interest rate will be too high, your mortgage insurance will be too high. Whereas FHA doesn't penalize you on mortgage insurance regardless of what your credit score is. It could be 580, it could be a 740. The rate is the same across the board. So this is huge for people who have anything less than a 680, sometimes even 700, depending on the scenario. Max debt to income, 56.99%. What that means is typically on a conventional loan or what they do is they say, hey, we don't want you to have more than 50% debt to income. So if you make $5,000 a month, then 50% of that would be $2,500, which means your mortgage payment, your car payment, anything on your credit, you combine all that and that cannot be above $2,500. So FHA is a little bit more lenient in that, and they'll say, hey, we'll go up to 56.99%. Now, just because they will go up to that doesn't actually mean that they'll accept it. There's other mitigating factors, but just know that they have a wider range to be able to accept people with lower credit and higher debt to incomes. And then upfront mortgage insurance. All right. What is upfront mortgage insurance? Well, we're going to get into that here in just a second, but just know that for them to take this risk of, people who might have lower credit scores or higher debt to incomes, that's a risk, right? And all risks are calculated. So what they're saying is, hey, we'll take on this risk as long as you guys pay for mortgage insurance upfront and you pay for monthly mortgage insurance for the remainder of the loan. Now, the upfront mortgage insurance, where people are always saying, hey, I want closing costs rolled into my loan. You can't roll closing costs into your loan. However, you can roll upfront mortgage insurance into your loan. And I'll show you that here in just a second. Again, monthly mortgage insurance, you're paying upfront of 1.75, and then you're paying a monthly mortgage fee of 0.85. And you're paying that typically for the duration of the loan. Unless you put down 10%, then you pay it for like 11 years. But if you're putting down 10%, you're probably going to go conventional. Probably, right? There's no absolutes in mortgage. So essentially, you got the upfront mortgage insurance, you got the monthly mortgage insurance, and now I would like to show you what all this looks like. So here I created a calculator. It's an FHA calculator for me. This is what I use. And let's say we had a purchase price. By the way, you guys, as of right now, the loan limit is $400, meaning you cannot have a higher loan amount FHA higher than $441,000, $441,600. That's as high as you're able to go as far as the loan.
Now, that means that the actual purchase price is a little bit above that, right? Because you could put 3.5% down, and then the loan isn't, the base loan amount cannot be over 441. So essentially right here, we're just going to say, let's say you have a purchase price of $400,000. Well, now it calculates 3.5% down, which makes it a loan amount of $386,000. But now listen, upfront mortgage insurance, just to obtain this loan, they're going to charge you 1.75%. And that equals a total of another $6,700 because it's a risk, right? It's a calculated risk that they're willing to take, but you have to pay for that risk. So but that gets rolled into the loan. So many times people are like, hey, Ruben, I put 3.5% down. Why is my loan amount $392? That makes no sense. It's because mortgage insurance is rolled into your loan. Now, we have interest rate. Let's just say today's rate, roughly 3.75 FHA. So now it calculates down here to a monthly principal and interest of $24.50. Okay. I'm going to estimate $200 for homeowner insurance. It could be as low as $70. It could be as high as $300. I mean, probably won't with the lower loan size. $200 is probably actually too much for this loan amount. Let's just go with $150. Taxes is probably too much, but I don't want to underestimate too much, right? I want to make sure that we're overestimating, and if the numbers come in lower, then perfect. Which is why what I do is I offer this calculator to all my pre-approved borrowers so that they can go out and say, hey, let me type in these numbers. Just because I say you're approved for 400,000, that doesn't mean that you won't be approved for 410,000 somewhere else, right? You would be approved for 410,000 somewhere as long as, you know, the taxes are low enough. There's no HOA. There's other mitigating factors. So I give all my clients a calculator. Most loan officers will never give their client a calculator because they don't want them out there shopping. Where I say, let's shop. Let's be transparent. So monthly mortgage insurance. This is the 0.85% that's being tacked on to the loan for essentially the life of the loan if you're putting down 3.5%. And that's never going away until you refinance into a conventional loan. And we could talk about that at another time. HOA, we'll just say this house doesn't have an HOA. So essentially, if you want to purchase a $400,000 home, you're looking in the ballpark anywhere around $3,000 to $3,200, maybe $2,900 to $3,200 for a mortgage payment. Now, listen, I know that might sound daunting and it sounds like a lot. It is. I'll be talking a little bit more on another video about why still is now a good time to buy, because you can have sellers buy that interest rate down. You can have sellers pay for your closing costs. You can literally save thousands upon thousands, like not a little bit, like $9,000, $10,000, $12,000 that would normally come out of your pocket. You could save that at this moment in this market. I'll be talking about that later. Hopefully this was at least a little bit entertaining, because I'm not very good at these presentations. It took me a while to put this together. Hopefully it's entertaining. Hopefully it's something that you guys learned something from. And if you have any questions, please give me a call. I'm happy to answer any questions, go over the process, and explain everything. And especially if you're shopping, shop my rates, right? You want to make sure you shop, because right now it's better to it's important to get the best deal you can. All right, guys, I hope you guys have a good rest of the week. Remember, life is not meant to be, it's meant to create. Too strong.